So I think you want to go into Preston and the loan officer and the loans.
So specifically speaking, we're going to talk now about conventional versus FHA.
Right.
Because we just mentioned in this episode at the beginning that FHA is the traditional route, right? You always hear, especially on TikTok and YouTube and all this stuff,
Yeah.
oh, all you need is 3.5% down. Remember the other part of it. You're going to need 2 to 3% for closing costs on top of that, and also an upfront, usually about 1% PMI payment.
And so I'll just get into it real quick. Closing costs is all the fees and all the associated dues that are owed for closing, which is like pretty much you're writing down your name, signing all the papers. Because there's I guess just to people that don't know what closing costs or PMI mean, if you want to explain that a little bit. I guess that's what I'm trying to do here.
Yeah, so PMI is your mortgage insurance. And what they do is, especially if you have a lower credit score, which we'll talk about credit score in another episode, it's a very important aspect. And I know you guys saw it on the DTI sheet when we brought it up just a few minutes ago. But it basically protects the bank because they're loaning someone with a bad credit score a very, very large amount of money.
Yeah. So it fluctuates. It could be very small if you have good credit, or it could be really high if you have bad credit. That's kind of what it comes down to.
And the reality is, if you're going to put down less than 20%,
they're most likely going to.
Oh, you're going to get a PMI.
You're going to get a PMI.
No, it's a given, 100%.
Yeah, it's a good idea to factor that in.
Yeah. So talking about conventional versus FHA, FHA is the first time home buyer loan backed by the government.
Right.
So the idea that we had was we kind of wanted to keep the government out of our what we were getting into when we talked about wanting to buy another house
within a year
as a residential buyer before we became investors, because again the rate's going to change. And also that's the thing about the FHA versus conventional, is that the rates are going to change. So don't be afraid to ask your lender. He can write up so many different types of mortgage packages, which we'll talk in another episode about. But first, you want to talk to him about, should I do a conventional versus an FHA? Because conventional, you only need 3%. People, like I said, people always talk about 3.5%.
Might be a misconception.
It's a misconception. You only need 3%. And we are living proof of that.
Yeah, that's true. And so we took that route instead of the FHA loan. Because, like you were saying, just to reiterate, is just to avoid any, because it's from the government, there's more stipulations, more things that are revolve around doing it that way versus doing just straight conventional.
Right. And if at already this point you're worried that you don't have the capital down payment or the closing costs up front, this is where the difference between conventional and FHA is gonna be very helpful. Because if you have to put 3% down versus 3.5% down, you need less capital up front for the conventional loan, which is what our experience was.
Yeah.
Because on top of the FHA PMI, you have the upfront PMI. So you have to pay 1%, 1 point something percent upfront, plus monthly you have to pay about $100 or more. $100 to $200, I would say, depending on your credit score.
Right. For the PMI?
Yes, for the FHA loan. So the thing about a conventional is you will have a PMI. However, once you get your loan to value to 80%, then you're going to be able to remove the PMI. And what a loan to value is how much is your house worth versus how much the bank has loaned to you. And what that means is, as you pay back your loan over time, your loan to value will decrease. So you're going to start at about 98% is what I believe we are at. But then as you pay the principal down, you can get to 80%, and therefore your PMI will be removed completely.
Yeah, just refinance. Yeah, that's a good idea. So I think that goes into the next topic, which is understanding the budget. And I believe you spoke to the loan officer about that. I know we already had a consensus of trying to get a budgeted out, trying to get a place that was under $500,000, get it down to at least $200,000 to $300,000. And so we kind of went that route. But I don't know if the loan officer mentioned anything that kind of also gave you that.
So, yes, what it comes down to when it comes to what you can afford, talking about shopping for a budget, it really matters where your money is coming from. Because since John and I were already members of PNC Bank, the loan officer looked at our accounts, because we gave them permission to to give us more of an advantage to be pre-approved.
Right.
And he noticed that we didn't have the funds in our account, and that is because
well, I guess that's kind
I
of
was sourcing from from a different account than my main checking account.
Right. So
I know John also had a different source of funds, which his was all in cash. A lot of his was in cash.
Right.
I also had some cash, but I also had a 401k. And the first thing that he asked us was, "Hey, you guys can't afford a 500k loan based on what I see in your bank account.
That's kind of
so
what we're
where
trying
is the
to
money
get to.
coming from then?"
Yeah. Exactly.
And
So
immediately
like,
I said,
harsh
"Hey,
reality.
here's my 401k.
Right.
Like we have enough for a $500,000 house." And he still said, "No, you don't."
Yeah, so that's kind of the reality he gave us for sure. So I think that also helped with our, because I know you were strong on that, like, you know, keeping it under 300,000, you know, keep it a certain budget. So I guess that's kind of what we got from him. And to go into the next thing, we realized that our debt to income was also like at a decent rate, and we figured we could take advantage of the conventional and the you know, where we were okay for both ends, I think. And then I guess the next thing was realizing that in order to get to a certain amount of, I guess getting 20% of your loan paid off, refinance at 80%, so you can remove that PMI. And there's different ways to do that. You know, like what we're doing now is working with somebody, a friend, whatever it may be, to try to help pay off a mortgage, you know, whatever it may be, renting out. And that's kind of what we're doing now, I guess. So
yeah, I mean, so the first step, and again on the DTI sheet, you can see here, we had an estimate of what our payment was going to be, which is how we got to $300,000 budget conclusion,
right,
based off of the market rate, which we estimated was about 5.5% at the time. And
interest rate, I guess.
Yeah, and so what we had was a high end number, because one way to talk about the strategy you're talking about to get your loan to value to 80% as quick as possible is you can pay an extra amount on your principal per month.
Yeah.
So
you don't necessarily need to pay what they're telling you to pay. You can pay more, especially if they don't have that prepayment penalty. So if they don't have that on the loan. And it would be a good idea to make sure that's not on the loan for people that are out there. That way they can be able to pay more of that mortgage off, refinance it, and be able to get that PMI off as soon as possible.
Yes, exactly. Yeah. And yeah, we can go into all of the different ways that you can get your LTV to 80% quicker, because that's going to be one of the main pieces of becoming a real estate investor in your mid-20s. Because the fact is that, you know, we don't have as much capital on average as a 35, 40-year-old married couple, you know, because they can combine their funds. It's a lot easier to source those funds like we just talked about. But since John and I came up with our own funds separately, the loan officer kind of forced our budget down, and that's where that kind of came from.
Because, yeah, we were trying to get a joint loan, and that was kind of our idea to, like, get the ball rolling on getting a house. And I guess to bring it full circle, the reason why we went to the bank was to, like, figure out the processes and the steps. And we learned that day to make things go smoother is to get a pre-approval. And that's why we even got into contact with the loan officer. Was Betty mentioned, you know, get a pre-approval. Realtors, people will take you more seriously if you have a pre-approval for a certain amount. You know, it's better to move that way. So that's kind of what we ended up doing there that day, was get in contact with the loan officer, talk to him, get a pre-approval for about, I think the first number we got was 280,000.
Yeah, we can go ahead and show. We'll bring up the pre-approval right now.
We'll blur out whatever we need to blur out.
Yeah, but later. Our first one was right here, and everything's blurred out except for our interest rate and our loan amount and our down payment. So that way, you all can see that we put literally 3% down, and that's all it takes. However,
that doesn't include closing costs, I don't think.
Yeah, so
that's one thing that you mentioned before, was to make sure that you have money for closing costs, which is, like you said, about 3%, 2%.
Yeah, so you won't get an idea of what your closing costs are until you get the loan estimate, which is actually it has to look a certain way according to federal guidelines. But as opposed to the pre-approval that you guys see on the screen right now, this is a super informal document. Meaning that, look, I'm gonna scroll through a few of them. Here's one here from Northwest Federal Credit Union. You can see the interest rate is lower. Loan amount is about the same, but it looks totally different compared even to this one from West Banco. Here, the interest rate is not even that noticeable. It's kind of like, on the last line in the corner. But again, the purpose of this letter is just to prove to a realtor or to a seller that you have
The funds.
the funds, and you have the funds and the backing of a bank, because all of these, as you can see, all three of them had a letterhead from the bank coming from. So, and here's something that I learned. I never had to pull this out the entire time. It's kind of like that movie, Catch Me If You Can. He just hands him the wallet, and then he doesn't even open the ID to see the proof that he was actually an FBI agent.
Yeah.
That's the same thing going this route. You can just tell the seller, tell the realtor, I have a pre-approval. I would suggest 100% get it done, because that's going to give your mind, that's going to put your mindset in the right direction as to what you can afford, because that's a huge part of the process, especially in an appreciating market like we are in.
So I guess the pre-approval is to let everybody that's looking, it's just to let the realtor, the seller, whoever it may be, let them know that you have the funds available, that you can afford to pay this much money and get a loan out to pay the price of the house. So that's kind of what the pre-approval is for, and we learned that day. And so we ended up, getting the pre-approval for, I believe, a house in Baltimore, right?
Yes, that's true. So,
or was it the other one? I think it was the other one, the greenhouse.
The pre-approval, you don't need to tell them where you're going to live. The loan estimate, where it talks about closing costs, because that's where they bring into play interest. Taxes, like property taxes, are going to change depending on where you buy a house. So the pre-approval is a totally different. Is totally separate from where you're going to actually buy a house at. The pre-approval is just a letter. It's a very informal letter stating you have the backing of a bank. This is the interest rate you're going to get, and this is the amount that you can have up to buy a house. And again, we didn't have to show this to anybody until we actually finally signed a contract.
Yeah.
Which you're not going to be signing a contract for a few weeks at first.
At least till you
even if you're moving as fast as we did, it took us 2 weeks at least before we even found a house we wanted to offer on, because we had to start shopping at that point. And before we get too much into shopping, which will be the next episode, we'll talk about the things that you need to prepare yourself for before shopping. Now that you have the pre-approval, now that you have the backing of a bank, now that you've discovered your strategy, these are important things.
Your budget, what you're doing, what loans you think you prefer.
Yes, so
we recommend conventional, but I think this could also work for people who don't want to run that, just getting multiple properties, and maybe just go for FHA. But people who are listening that are interested in doing what we're doing, definitely go for conventional. I think would be the best thing.
Yeah, we definitely decided conventional was the way to go, and that, again, the main points on that are that you can remove the PMI, which is about $100 to $200 a month.
Yeah.
After 80% LTV, loan to value. And then it also depends on your strategy, because our strategy is to rent. And the first renting strategy we had is house hacking, which means you're going to shop for a house that has 3 bedrooms, but you only have one business partner. So 2 people are living there, but then you find a renter to take a room, and that's called house hacking. And that way, that's a strategy to get your LTV to 80%, because that's the main goal, to start with your first at least 2 properties. Get them to 80% as quick as possible. Another strategy could be,
I guess, to go over the things that you said, because I kind of cut you off earlier, to circle back. You said once you get the pre-approval, you get all the things going, what are the next steps to, I guess if you could think of one, because I know we're talking about, we're jumping into, once you, I guess, ways to pay off the loan quicker. So I guess what would be, is that part of that strategy? Once you get the pre-approval, what loan you want to get, is thinking of ways to pay off the mortgage as fast as possible.
Yes.
I guess that's part of that process.
Yep.
Okay.
Yeah, that's one example of how to get to pay off your loan quicker. Another thing is, if you have the income to do this, you can just pay extra on the principal every month. For example, if your mortgage payment's $2,100, pay your $2,100 directly to the bank. but then add an additional $400, and you can send that check whenever you want to the bank and say, hey, this is for my principal. It's not a part of my mortgage package, so therefore it should be applied directly to the principal.
Yeah. And I think people have that misconception where it's like that mortgage. So your mortgage may be $2,400, let's say. Realistically, you're only paying maybe $100 towards principals. That means you're only paying like $100 to $200 of what you actually paid for the house, and the rest are just interest rates, all that, PMI, insurance, whatever it may be.
Yeah, it goes towards insurance, taxes, and a lot of it at the beginning is going to go towards your interest rate. So you're basically paying the bank back at the beginning the most, and then as time goes on, you're paying the interest rate less, and you're paying more towards your principal. This is an amortization. That's the loan we took. This is opposed to a cash buy, which again, if you're 26 years old,
there's no way you're doing cash buy unless 25. You're like making hundreds of thousands of dollars every year before you're like 25 or in your 20s doing that.
Yeah, and if you're doing it,
but if you are perfect, do it. By all means. But for I guess this is more for people who have maybe making like $2,000 to $3,000 a month, or people who are even making $1,500 a month, $1,500. You find someone that's making the same. You have two heads making $3,000 a month combined. Save up money, find a means to an end to try to make this stuff happen. Because you don't need much, like we mentioned. You only need a few $1,000s, maybe for like a $300,000 place to get into a little bit of what we did. If you're, let's say, rough estimate, kind of what we did for a $300,000 place, you're putting up at least $20,000 So, and you may not have all that saved up, but it's possible. And I think the next episode we might touch into that, but I think it's what comes down to is having that mentality, having a plan, putting it into action, what your numbers you're working with, and being able to do that and take that step. And I guess we did that, and I think it's important for people to realize that you don't need to have a lot of money. If you're even making like $1,500 a month, that's fine. Find someone that has the same idea, that they're trying to invest into something. Real estate is perfect. You buy property with somebody, you get them on the title. There's nothing wrong with doing that with somebody that is on the same sort of idea. What it comes down to is time. Where me and you are 25. We're not like, if we were to take the traditional route, we would end up maybe investing, who knows how many years into paying the, in general, like just if we were to, just to start over again, if we were to take the traditional route, we would end up, buying the house ourselves, saving that $20,000 ourselves, and then who knows how long it would take for you to get to that point where you have 4 properties, you have all these, things rolling at the same time, renting, all that, whatnot. That'll take you on your own, if you're making like so much money, a very long time to even save up. And then even then you won't be able to, if you're making $1,500,000, you're not going to get like a $300,000 place. Maybe you can afford an apartment or a condo for like $200,000. So it's just to keep all those things in mind, finding somebody that you can work with, or doing it on your own, trying to get yourself promoted, make $2,000 to $3,000 a month. That's what it comes down to. We're just here to kind of give that people that inspiration to, you can do it. You don't need to, have all that money together now, but at least, have that mentality to work on it and have an idea and a plan.
Yeah. So just to wrap everything up in this episode, just find your strategy that works for you. Talk with your banker, talk with your loan officer. Those people are willing to help you. Our loan officer was emailing us and calling us on the weekends at midnight. They were all over the place. Again, we were trying to move fast, and we were trying to work with a banker that moves fast. So we started off with PNC. They gave us, as you guys saw on the pre-approval, an okay rate, but we also met up with other banks. And at the end of the day, you're going to want to find the best interest rate to work with your strategy. And since we know that we were going to refinance after a year, we chose to compare with other banks. And that's also going to determine what kind of house you're looking for. 3-bedroom, 2-bathroom, 3-bathroom. These things are very important when it comes to shopping for a home, which we'll talk about in the next episode.
Yeah. And just to throw one more thing in there, we might talk about this next episode, but leveraging these pre-approvals from different banks to get the best rate possible, just to throw that in there, because I know we mentioned it before. It's important to shop around. That's one rule we've always had. not just in the, okay, so we're going to talk about it. Okay, perfect. So that's just one thing to keep in mind for people is always, just never just settle for one. But, like he just mentioned, or you just pointed out. So we'll talk about that in the future. So yeah, 100%. I think that's pretty much it. If you want to add anything, I know you had closing thoughts, but if you want to, close out again.
Yeah, I mean, all I got to say is like and subscribe. We're the 301 Club, giving you the 101 on real estate. My name's Chase.
My name's John.
And we are 301 Club, so like and subscribe.
Thank you, guys.